is Vladi Sasek. I'm the managing partner of Westpac Wealth Partners, and I'll be your moderator today. The format for today really will be to do this sort of a panel style seminar. I'll introduce our members of the panel in a second, but we encourage you to ask questions and participate. It's an intimate enough group where I think we'll have the time for that easily. Big question is, why are we here? This Business Exit Planning Advisory Board has been around for 5 years now, and really their mission is to help business owners in Hawaii with exit planning. This is because I believe, as owners of small, closely held family businesses, which I believe most of you are, you're probably the most underserved group from a planning standpoint. There's 127,000 businesses in the state of Hawaii. 97% of them are small businesses, what a Small Business Administration will call small, with less than 500 employees. And then, out of that 97%, another 98% is what we would consider micro businesses, where you have less than 50 employees. And that's a very unique financial dynamic. It's really hard to say, here's where the business finance stops and personal begins, and vice versa. There's a lot of overlap area. And the challenge that you guys face every day is to leverage the fact that you're a business owner for personal financial gain, and vice versa, leverage your personal finance for either business growth or exit strategies, which is really what these guys will address this morning. So, without any further delay, I'm going to introduce the panel. I'll start with Mr. Ethan Lee. He is a CPA and a Certified Business Valuator with Cooper Norman. He's dedicated his whole professional life to really business valuation, and he will get into details of how certified business valuators go about valuating businesses and assigning value to the business. Obviously very important to and relevant to the topic that we're discussing today. We'll also have Charles Au.
When I'm not waiting tables.
Charles is a CPA and a managing partner of a firm called ECA Advisors. It's a CPA firm that's been around for 50 years. Charles has been with the firm for about 30 years and is a wealth of knowledge when it comes to the tax planning relative to exit planning. Next person is Scott Settle. He's an attorney with Settle Mayer Law Firm. He brings a wealth of experience to the exit planning, having gone through an exit himself and understanding the planning process, but also there is legal aspect to the exit, and his firm specializes in that. And last but not least, we have Marko Miushkovic, who is the Certified Business Exit Planner, and he's dedicated his career solely to helping owners of small, closely held family businesses with exit here in Hawaii. He even has a very popular radio show that is all about exit planning. So, welcome, and I hope you're in for a treat. So, we'll start with some questions. So, first question, I'll start with Marko, is can you tell us what exit planning is, and why would a business owner need an exit plan?
Thank you, Vladi. And thank you all for coming this morning. First of all, like, you are all small business owner or owner of the business that pretty much built this business for like 20, 30 years, and you are at about the point to think about how you're going to get out of the business. So business exit planning is a process that business owners should take up on probably 3 to 5 years before you actually want to get out of the business. So it's a 7-step process that we practice, and we help the business owner go through the structural process with the set of steps that you're going to go through in order to successfully get out of the business. The ultimate goal is to get out of the business in style. How I say in style. Why in style? Because you want to get a maximum amount of dollars for your business and pay minimum taxes. So if you want to boil down the exit planning, that's it. You want to get out for a maximum amount of dollars or a minimum amount of taxes paid. How you going to do that? Well, it's a process. So we go through the 7-step process. First step is identifying the time when you want to get out. So most of the business owners are thinking, well, I want to get out yesterday. Well, you could get out yesterday, but with the certain consequences, and those consequences are usually you're going to be getting probably not a full amount of value for your business, and you're probably going to pay more taxes than you're supposed to. Second step is figuring out like what is the value drivers and figuring out the value of your business and value of your personal financial situation. Meaning like, what is this business worth? Like Ethan is going to say that in a little bit, like most of the time you know the value of your stock portfolio or your retirement portfolio by logging into your retirement account, but you really don't know what the value of your business is until you get to the point that you need to appraise that business and figure out like, is my business worth something? Do I actually have a business or I have a job? So that's the second step. We figure out the value of the business. Third step, we're figuring out who we're going to transfer. Is the transfer going to be internal or is it going to be external transfer? So in the step 3 and 4 and 5, we're figuring out what is the value that we need to bring up to if the value is not appropriate on the level you want to see it. Who we're going to transfer this business internally to the employees, family members, partners, or externally sell it to the third party. We see this year and last year, we see probably more and more external transfers that are happening, and that's usually like a trend right now. Why? Maybe it's just a coincidence. In the past, we had probably 9 out of 10 internal transfers, but now we see more and more external transfers selling to the third party. Step number 6, once we identify who is selling the business, we need to figure out.
Did I miss one? I was on 4. What did I do wrong?
Okay, so first one is the time.
When?
When.
What's the business worth?
Second one is the value.
Yes.
Third one, we need to figure out what the value drivers of the business are, so if you need to change the value or increase the value. Number 4 and 5.
I'm sorry, I had internal or external transfer.
That's 4 and 5.
Oh, I'm sorry. It must be like 7:30 in the morning. Okay.
We're going to start serving alcohol in just a little bit.
Let's go to 4 and 5 then.
We'll give you more coffee.
Espresso.
Yeah.
So 4 and 5 is who we're transferring the business, internal or external. Number 6 is a called continuity plan. What if something happened while you're waiting to transfer your business? What if some kind of event happened that is going to actually push you a little bit back? What if something happened to the business owner, so business owner either pass away or become incapacitated or just leave? And the family still depends on that business. So we want to make sure that you have a plan. We can talk about these individual steps in a little bit more in details because they're all equally important. And by the way, they don't need to happen at the same time. As long as we fulfill those 7 steps, and sometimes business owners, when they come to us, they already know who they want to transfer the business. So we skip the step number 5, external transfer. And number 7 is actually how this estate is going to be passed down to the next generation. So even though the planning process is 3 years minimum, 5 years, 7 years, we actually want to see the plan after everything is done for more than that many years. So just to recap, it's a process, it's a 7-step process, and importance is high because this is ultimately your PhD. This is your final event that you're going to take up on. So you don't want to rush through it.
Very good. Okay, so it sounds like after somebody has decided on a timeline, that the first next step is really business valuation. So Ethan is a certified business valuator. Can you tell us a little bit about that process, how it works, what you look at, how do you determine the value of the business, and you know, sort of the timing of when should a business owner get a business valuation?
Yeah, I guess starting with timing, as Marco mentioned, the earlier the better. Obviously, once you have an idea of what your business is worth, then you can start making plans to either maximize the value through the valuation process. We identify those drivers, the value drivers. So cash flow, how can you improve cash flow? Risk is the other big one. What are the risk factors? Is the business totally dependent upon you, or do you have a partner? Do you have management in place? If it's all on you, then obviously you probably need some time to get some key people brought in and sort of diversify that risk out. And the value drivers, obviously, if you increase cash flow, decrease risk, that's going to increase the value of your business. And then I think another just important aspect of when we're doing this, and my experience has been with these, especially the family-owned businesses, is that, and we were having a conversation about it just before the meeting here, that there's so much personal and emotional attachment to the business. Oftentimes, it's the identity, right, for a lot of people, especially if it's the owner-operator. So having the valuation done, especially from an independent party who's devoted or specialized in this area, really is helpful, I've found, to the business owners to actually try to put on the buyer's hat and look at it from an investor standpoint. Would I buy this business, and what am I buying if I'm buying it? And so anyway, it's a fun process, and I really enjoy it.
Can I ask a question?
Yes.
I don't know how much specificity you want, but from our standpoint, Bob and I are partners in the business, that is a concession. And that concession, we've been at it for 30 years. That concession has currently 8 more years on the existing contract with a monthly rollover after that. Is that something that actually can be valued and marketed, or is it too short a time frame?
So the contract then is specifically?
Yes,
And
the contract, the concession agreement
Right, the concession agreement.
terminates in 2027.
Right, okay. And is there an option to renew? Is it transferable?
It is, no,
No.
that's,
Okay.
it's only transferable with permission from the grantee, which in this case is a large hotel corporation. And we go automatically per the contract to a month-to-month, unless they say, no, just get out the property,
Right.
which technically they can do it.
Yeah.
Although, like I said, we've been there 30 years. So.
Okay.
We've had 3 of those contracts that are always renewed.
Okay.
For
We've
another
extended,
10 years.
Right.
we've done countless 5-year extensions over the years. We may or may not have the opportunity, but in the next 8 years, we don't know that.
Right.
So when you come to value our
Yeah.
company, are you looking at an 8-year timeline and out? And does that,
Or the historical pattern.
Yeah, exactly.
the core question, is it worth doing a valuation on a company with shorter than a 10-year time span? Is it
Yeah,
even worth-
so my brother owns a business up at Turtle Bay Resort. He same deal, he signed a contract, and the private equity firm just bought Turtle Bay. Things are
Right.
changing already, and so
Yep.
but with as you mentioned, the historical pattern, has it been extended or renewed before? Could be an indication that it's possible and that it's happened. To an investor, that's less risky, right? The perception of risk is lower because it's happened before. We'd have to, obviously, it would come down to looking at the terms of the contract and making sure that it is transferable, or if the contract is in the entity's name, making sure that the buyer could, that it wouldn't be voided.
Thanks for sharing that,
Yeah,
Michael.
that's it.
Because what's the good part about it, and process-wise, knowing that that's a value driver, maybe the idea is to talk to your attorney and talk about going in early and getting renegotiating something now and getting it.
Either that, or taking the assumption that it would not be renewed as a business proposition. We're now more in the realm of wind down estate planning now
Yeah.
Sure.
and out, because we're already old coots anyway. I mean, it's kind of like, if it leaves us or we leave it, I mean, it's kind of a push, right?
81 is not old.
And so to answer the question, it can be valued either way, right? We can say, yep, 8-year period, done, or we can say 8-year with the likely
Right.
possibility it's going to be extended, so then there would be a cap, what's called a capitalized, kind of a terminal period valuation that would go.
But it's still
into that
worth
8-year
doing,
stream.
looking
Yeah.
at valuation even
Oh,
in
yeah,
this
especially for the
environment.
estate planning process, yes.
Is there a possibility of changing location?
One thought, we've turned down a lot of opportunities to expand to other hotels because we have a very unique structure where we're at. But with 8 years to go, there could be an opportunity to acquire 2 or 3 or 4 other operations. And eventually, if we do leave this property, take our marbles and our staff and populate others.
So right there, you answer your question. So there is opportunities to do something else, and
Yes.
since you have 8 years, enough time to mitigate that risk, that's probably a risk. 8-year contract is up, so you have
That's right.
enough time to figure that risk out and maybe change location, or expand locations, or do something. So there is still value to that business regardless.
And there, you know, there's another point here. I'm looking now from the, even though I'm 81, I'm looking at this from a perspective of a millennial. There are companies that, like Uber and the other companies that, you know, are on the crossover into residential areas and Airbnb and that kind of stuff. Our company, and one of the reasons we haven't expanded is because we have 2 philosophies. One is safety first, that gives us almost a perfect record. And the second is that we do no encroachment into any area that's not zoned for what we do, and we don't leave Waikiki. And so none of our customers, which are in the multi-thousand, when they use anything that we do, it's all in Waikiki, no residential neighborhoods and no highways. We don't let them on the road. And the third thing is that we're 0 carbon footprint. And we've maintained that for 30 years. So we have a very unique requirement of any expansion opportunity.
And that's a value driver on its
Yeah,
own.
and
So it's,
from a millennial perspective, you know, our 70 employees, which are mostly millennials, appreciate that fact.
So, I think you guys brought a very good point of partnership, and I think most business owners, when they think about their business and value of their business, focus on the actual valuation number, ignoring that the partnership that you all have, regardless of whether you own your business at 100%. So I would like Charles to talk about the silent partners and things of that nature.
What a great statement. Excellent. You naturally have a partner you're looking at, right? You came together. Anyone else? Sole proprietor? Own 100%? Yes. Yeah, good. Who's your partner? Don't have a partner. It's not on title, but he gets his share.
Uncle Sam.
There you go. Thank you, Uncle Sam. And then Uncle EJ, right? They get their cut no matter what. They get their share no matter what. They get particularly excited in a sale transaction. They're just rubbing their hands together. They really wanted to go. They wanted to go because they're gonna take some money on the transaction, and they're gonna sink their claws into whoever's coming in behind you, right? When you get ready to sell. In the traditional sales setting, you take whatever you got your company, your assets, whatever they may be, you get a valuation, you decide on a price, you get Scott to put the legal documents together, and you sell it. Shake hands and get your money, they get your stuff. What happens? You pay capital taxes, capital gains tax, right? It's supposed to be 20%, gotta love Trump, right? State of Hawaii, 7.25%, 27.25% at the low. We know at that kind of number, anything over $1 million, you're going to pay AMT. That's 26%. So 26 and 7, you're at 33. Government's going to get a third of your money. Right? On the buyer side, what do they have to do? Normally, unless it's a VC firm, they got to make the money. You're going to take it over time, or they're going to do it out of cash flow. So what do they have to do? Even if they borrow the money, what do they have to do? They got to make the money from the company, make a buck, pay 40% ordinary income tax, right? To get you 60 cents on the dollar on the sale. So they got to make about $1.50, right? 60 cents off of that to give you your dollar. 50% tax there, 33% tax there. What is it? 83% of the deal, for sure. So highly inefficient, right? to do just a traditional sale. So part of the process that we go through here is knowing what the valuation is going to be. You got to assign a good number, a fair number to the actual transaction. But what else can we do to bring value both to the buyer and the seller? I can share with you for the sale of our company, I'm transitioning my partners. When we bought my partners out, we assigned something to the goodwill. We assigned some value to the assets, to the customer list. And then I kept my partners on as owners. And by giving them a K-1, I don't have to pay the tax on that. They get a K-1. Whether they get out of it continuity, they stay around, they help transition my clients, they get health insurance. I'm hyper-funding their retirement plan. Great for them, non-taxable currently. I'm getting a tax deduction for it, right? Because it's an employee retirement plan. The efficiency on the tax is huge. Tax deferred for them, I'm getting an already deduction.
So I'm presuming you have an LLC then?
LLP, yes. So it's passed through.
Okay, well that's, you'll have to explain the difference in that.
It's the
And
same.
It is the
For
same.
tax
purposes.
Yeah, yes.
Okay, and you are the managing member, and you have, not general members, you have, I don't know, are they passive, I don't know.
Good point, yes.
What's-
We've had to create a second class of membership where they're non-managing. They don't have the say. They get their share of the money, but they're not involved so much in the direct management of the operating company.
Gotcha.
They're still operating, they're still active in the
The
business.
separation.
Yes.
Okay.
Great point.
That makes sense. But that's advantageous to them, just getting whatever is distribution.
It's
as
a
passive.
K-1, it's ordinary to them, so they're gonna pay ordinary tax, so great point. Tax inefficient for them, they're paying 40% instead of 33. We do a tax equalization, and I just give them the other 7. So another example of how they're gonna get something more.
Oh, really?
Why would I give them 7 when I'm saving 40? It's all day, right? I'm actually giving more than that, I'm actually giving more like 15.
So you are making it worth their while. But it
Part-
comes out of your pocket because there's enough extra.
Part of the process, right?
Okay.
We're taking money back from our third partner, or the person that's not doing much for us, right? Taking some of their money and redirecting it to us. Just one example from a tax standpoint, but certainly part of the process that we want you to go through.
So as a part of the process is what we call financial transfer. After we do valuation and we figure out what the value of the business is, we know what the value needs to be passed down to the partner, to the owner, the partnering owner. So we need to figure out over time how we're going to structure the deal so it's tax efficient. So you actually pocket that amount of money what you transfer plus some. So we usually use this example because it's usually what's going on out there. You want $5 million for your business, but the business is worth $3 million. What do you do in a situation like that, right? And this is a real case scenario where Eaton came back with a valuation of 2.89 or something like that. But the owner wants 5. He's transferring internally to the partners, and guess what? They didn't ask for any money down, so he's getting his 5 because they don't need to do anything. They don't need to come out with the money. It's a pure earn-out. So we structure the deal over a 7-year period of time. Luckily, they're making a good net profit, so there is enough cash flow to fund this deal, the earn-out deal. On the end of the day, he's going to walk with $8 million.
If the business survives.
Business is actually thriving.
Oh, good.
And the reason why is before was only one guy, all the pressure on him. Now there's 4 of them, 4 owners. So there is more energy, more brain power. What do you think?
I'll start more skin in there.
Yeah, more skin in the game. So everybody's now like working extra hard because they own a piece of the pie.
So I think you brought up a great point with the structure of the company, and it sounds like that that is very important and it needs to be set up front, and it sounds like that being nimble and flexible is the most important thing. So Scott, can you maybe talk a little bit about what are the business documents that every business should have in place regardless of whether they're planning to exit the business or not, so that they can have that flexibility and nimbleness that Charles and Mark are talking about?
Sure. Well, obviously everybody knows when you set up your company, you have, if you're a corporation, you have articles of incorporation, bylaws, and minutes, and keep records of what has happened over the time. If you're an LLC, you have articles of organization and an operating agreement. Believe it or not, there's a lot of companies that gets established. You're not legally required to have an operating agreement. That's a kind of a partnership agreement between the members. There's a lot of businesses out there that don't have one, and they go online, LegalZoom, they file something, and they think they're in business, and then the bank says, well, where's your operating agreement, or somehow like that happens, or there's a fight between the members, like, well, what are your rights and remedies? Now you got to open up the HRS statute and follow the rules by the book, as opposed to having written what your agreement is and decided it yourself. So your organizational documents that show that your company is a company and it's legally formed and it's in place, and there can be just a couple of them, or there can be several of them, depending on how detailed you want to get. I think it's important when you're going to Ethan or you're going to a buyer to sell your company, that you also have paper. I mean, it's all paper at this point. That reflects what you're telling the buyer that you own. We have this space. Well, do you have a lease? Or maybe sometimes you own the building but you don't want to sell the building. You only want to sell the business. Well, do you have a lease in place between yourself as owner and yourself as a business? You need to have a lease or some location typically. And other types of licenses and permits. You might have a bunch of, if you're a computer-driven or a high-tech driven company and you're selling ideas, do you have the copyrights or the trademarks or whatever you might need to reflect that you actually own that, and if you've licensed it out, the proper license agreements. Do you have employment agreements with your employees? A lot of times businesses run no employment agreements, verbal agreements. If you don't have employment agreements, you should, that's a whole nother discussion. Even though in Hawaii typically it's at will and you can let somebody go, it's always good to have an employment agreement and an employee manual, because one of the things a buyer is going to ask you when they come in to buy your business is, do you have any problems with employees, or let me see your employment agreements. I want to know who you employ and how much you're paying them and what the deal is with them, so I can decide whether I want to keep them or not. So that's pretty important. And things like that, the stuff that makes up your business, it's good to have it papered, and so that you can hand it over to a buyer or to an Ethan and very quickly get an analysis of, yeah, I want to buy. Because oftentimes opportunities will come your way and somebody will say, hey, I'll buy your business. I'll have my guy call your guy and send him over the documents and information, and we'll make a decision. Well, you all of a sudden don't have it, and you got to go back and recreate 6 years or 10 years worth of stuff. It's going to take time, and you're not going to be nimble and able to transact.
Very good. Thank you. So on that, it sounds like that planning is really important. So Marco, can you talk a little bit about maybe pitfalls of not planning and what happens, and maybe some experiences, share some?
So I give you examples. Since Scott is talking about someone is approaching you and they said, I want to buy. Usually it's very, how can I say, very social situation. You're talking to someone, either is your supplier or your vendor or a friendly competitor or competition from the mainland or something like that. So you have this conversation and they come to you, and I'm giving you a real case scenario. I'm just not going to mention the names, but this is what's happening as of like this weekend. So the guy was on the show, he got approached by the vendor. He says, hey, I bought like 5 businesses on the mainland. I'm looking at you, I'm ready. I have some venture capitalist money behind me. I want to buy your business. And the guy gets excited, right? The good thing with planning for exit is just that this is a little bit too early for his timeline, because his timeline is next year, so we are like a year off. So he's calling me and says, I'm excited. I have 2 guys approach me. They both want to buy my business. What should I do now? I cannot sleep. Okay? So in his situation, we're ready to kind of absorb this information and then calm him down. Number one, you need to calm down. When someone tells you that they want to buy your business, that doesn't automatically mean that they're going to give you the maximum amount of dollars. Just think about it. If you're buying a business, are you going to pay the premium for some business, or you want to try to go, low ball and get as much as you can as low as possible? So that's number one. Calm down, take a deep breath, and go through the process. And the process is, in that situation, you need to, this is a third party, by the way, this is a third party sale. We do work closely with M&A firms that walks us through this process. We have an M&A firm from the mainland that helps with the third party acquisitions and sales. So the process is calm down, get your book ready, get your marketing material ready, get your financials in. By the way, we all finish all that. Internal stuff is all done. Now we need to focus on external. Get the book ready. Get someone who can negotiate the deal for you. You don't want to be the party negotiate directly with the sellers. First of all, you're emotional. Even though you say that you're not, you are, because that's your little baby. You know, you look at your business like it's part of you. So it's really hard to sell something that you were engaged for 30 years. Every business owner, before they sign the document with Scott, they go through the seller remorse. It's almost like you need a psychiatrist or psychologist to kind of like guide you through the whole process. So pitfalls are you get overly excited, then you rush into something, and what happened? You waste time. You 6 months later, 8 months later, you're into it, you're not getting anywhere because they're kind of like going through the due diligence, finding all kind of stuff. They start nickel and diming you. They don't want this part of the business, but they want this part of their business. If you don't have a process, you don't have a right team in place, those are usually pitfalls. Internal transfers, the pitfalls are what Charles was saying. You might be structuring the deal that is going to cost you so much money in taxes in order for you to collect that $1 from the buyer. And a lot of time, I will say this is for sure, especially in Hawaii, because we have, like I said, a lot of internal transfers. You might be having a buyer right there in your company, right there next to you, but you never consider that person because you know that they don't have money, or you think they don't have money. You didn't even ask. Or if you did ask, you asked like 5 years ago that that person was in a different situation. So I'm telling you, if you're a buyer or seller, you can really buy business nowadays for no money out of pocket. Or you can sell the business and get the maximum out of it without that buyer putting any skin in the game. Now, it's your choice if you want a skin in the game. I encourage the skin in the game because you really know for sure that they're serious. 10%, 15%, 20%, something that's going to put a skin in the game. So the pitfall of internal transfer is you don't even consider people within your company. And they might be there. So you don't need to look further than just around your office. Any questions on that?
Is that a traditional ESOP that you're talking about?
No, I'm talking about partnership buyouts or management buyouts or couple of employees buyouts. ESOP is everybody in the company when you don't have options and it's really hard to sell your business to the third party and the value is over $5 million, so your people within the company, it will take too long for you to sell it to them because the cash flow and everything. That's the time when you go to the ESOP, right? You're selling to all the employees. And it's usually leverage ESOP that you borrow the money from the bank, go to American Savings Bank, borrow some money from them, right? The ESOP is paying the money back over a period of time.
Yeah, but you're still on the hook.
Yeah.
You're on a hook.
You're not
Like
out.
people think it's easy. It's not easy
No.
because American Savings Bank is not going to release your equity. It's going to collateralize it for duration of their loan, and it's going to release it year by year as your collateral is like as the ESOP is paying off their loan.
Right.
So as an alternative, are you talking about methodologies based on cash flow, where basically an owner goes into something like an annuity environment where his business is writing him a check every month or every quarter or every year for a period of X number of years?
I
Is
don't
that
call it
tax
annuity.
friendly?
It's more like a direct payments kind of structure where
Like
they bid.
Could it be a percentage of existing gross? I mean, it's a simple formula?
Cash flow for internal buyouts or what we call earnouts, when the buyer is not putting any skin in the game, the cash flow is the key.
Yeah.
So what you do with that cash flow, you structure it over a period of time that slowly is buying the shares out. How? Maybe the first tranche of the shares is going to be the loan note. So you transfer enough shares up front to the buyer so that buyer, if they're in LLC setting or S-Corp settings, and that's what we prefer for transfers, that buyer has like percentage of shares. So when the buyer gets the K1, what is tax efficient to them, business reduce the revenue, buyer gets the money, doesn't pay the payroll taxes, and then turns their money to buy additional shares. And then of course there is a loan note probably over a period of time for that initial tranche.
is that an environment where you as the owner still own and operate it, and he's buying you out, and you're actually paying him? It just sounds inverted.
So how does it work? So usually owner stays on board fully active for a couple of years because they wanted to. And then after that, they're still getting paid salaries and everything, but they're reducing the time. So ultimately, you're trading a time for money, right? And then eventually you drop off and maybe just a loan note is what's coming to you after 5 years or something.
But in an operating sense, you can't have two dominant minds occupying the same little rowboat. You have heads butting and people saying, well, the buyer's saying, no, I don't want you to buy a new copy machine. I got, one in my basement. Don't do that. And you. I mean,
So I can defer you to Scott because what we do up front, there is a legal documents and there is a rules that are preset. So one of the employment contracts will specifically say what party is going to do and what owner is going to have ultimate control of and decision-making power and when that is going to stop. So you regulate a lot of that up front with the legal documents.
That experience is important too, because if these are people that are going to take it over, isn't it just better that you know how it might go, as opposed to just turning it over, being still on the hook for the loan, and then operating in a way that you don't believe will be successful? So that transition period, that friction that you're referring to is good, because that's part of the coaching, right? People come up and they rush to the owners, they've got ideals, right? These young people that come up, they want to do good, right, Scott? They want to do great things. I've got children that want to they don't need the money, they just want to do what's best for the world. Well, there's a combination there, right? There's a balance there. You got to make money so that you can do good. Right? That's part of that coaching that's going to occur. Circling back to, this is a process. The idea that you're just going to cut it over, give it to them, and say, good luck to you, bless you. It doesn't work. It doesn't work that well.
Is there occasionally you put in breakup fees and stuff such that after it's 18 months, this buyout is not working for whatever reasons? Either the business isn't doing as well, or the buyer turns out to be a real jerk, and or whatever the reason. Is there a high-speed off-ramp
That's right up Scott's alley, I think.
in these things?
Yeah,
Because
so
these
here-
are processes now.
Yeah.
These are handoffs, not here you go buy it, right?
Yeah, unless you're getting the full value you want and you're willing to walk away, you're right. There's some negotiation that goes on between you and your buyer about all these issues.
Okay.
And some sellers are I'm not turning over any control until I only have 5 or 1% left in the company, and then you go. And a buyer in that case, if you have a very young person who totally trusts you and just is happy for the opportunity, they might agree to that. Somebody who's older, sophisticated, who says, hey, I know how to run this thing. If you want me to buy you out, you got to give me some flexibility. It's going to be less likely to wait that long to take control. So that's a negotiation, and it really depends on what you folks agree to. But we can put any of those things in. We can put in a similar. We've done one where there was a question from the seller, just like what she had was, hey, I really want to sell to this guy, but he's young and I'm not sure how successful he's going to be. So if he screws it up, I just need the trigger to buy him back. I'll give him back the money that he gave me for his shares, but I want to get him out. We can put that in there as well, as long as both parties agree to it. I think if you if you have a good relationship with the buyer and you're talking them through these things, you should be able to do that.
Okay.
So you end up in the earn-out situation. You identify an employee. You both come up with a number. All the terms and agreements work out. What is usually that term that earn-out ends up phasing out? Have you seen 1 year, 2 year?
So it depends on the cash flows. So it depends on the selling price and the cash flow. So if there is a high enough cash flow, most of the time the price is higher because the valuation came back higher.
Mm-hmm.
So what we see is usually like 3 years minimum,
Mm-hmm.
and then 3 years, 5 years, 7 years. It all depends on the value that the owner wants to collect.
Is there a high? I mean, is there like you won't go any longer than 10 years, or? I mean, I realize it's going to drive off of the price.
So it's a live contract. So when the documents are set up front, it doesn't mean they're not going to be altered as you go. So if your cash flow increases over time, the owner says, well, we have more cash, so we can speed up this process and condense it. So like 10-year plan can become 7-year plan or 5-year plan. And also maybe in year 3, cash flow drops because something happened, a loss of key client or vendor or something, now we can extend. So it's every year kind of like once we sit down in a meeting in November and we meet and we look at the financials, we update the plan and see can we move faster.
What I think also affects it is the relationship between the buyer and the seller. So in these earnouts between family members, we generally speaking see longer periods of time on the earnout because they don't really care. 10, 15 years, you know, mom and dad are getting out, they can stay on for as long as it's efficient.
I'm just going to add that
Yeah.
it's probably going to depend upon the type of business too. If it's a professional practice, a lot of times the transaction is almost all earn out with very little fixed amount up front, and so you'll see longer periods there. But whereas maybe a manufacturing or retail business, there's going to be mostly probably a fixed amount that's agreed upon, and maybe like a 1 to 2 year earn out just to help transition.
In a professional business scenario, is it primarily the client list that is the asset? Apart from the office furniture? I mean, what else is there?
Yeah,
Relationships.
Right. The
Relations, yeah, well, that's kind of a goodwill thing, but
Yeah.
the client list is a client list. But it's got names and addresses and ongoing cash flow, right?
Yeah, so if it's a doctor that has ancillary services like an imaging type business, they might have a $500,000 easily piece of equipment. So there can be some assets that go along with it.
Understood, okay.
Also, in our case, we have other companies that are owned by our company, but they're always, we own majority interest in all of them. Those, I guess, would be considered part of your asset base. But you've got, each one of them has outside partners. So
Yeah.
you've got kind of a pyramid of,
And they're all related to the operations of the main business?
no,
No.
each one is sort of independent. In our operation, we have two, because we cover the entire board. We do everything there.
Yeah, so that takes a lot of planning because you're thinking about exiting out. If you're thinking about exiting out everything, great, but you may not have the same buyer for each piece. So you need to plan ahead and say, okay, I think I'm going to sell this business to this guy and this business to this guy. So you need to figure out how to separate them, and it can be done fairly easily, but there's documentation and filings and things like that.
And
tax
sometimes
planning.
it's not even like segregating a different entities, so it's all part of one entity. So one
Exactly.
entity
Yeah,
owns them all.
they wouldn't want to separate out.
Right.
They want to be
Right, it's
part
one
of it.
operation.
So it's
Yeah.
one operation, so they take time to segregate them, separate them, and
Right.
then spin off whatever you want to spin off at that particular time.
Ethan, can you maybe talk about different approaches to the business valuation, the pitfalls of rules of thumb that we often see, and then maybe talk a little bit relative to what the discussion was, recapitalization of the business, voting, non-voting shares, things of that nature?
Yeah, that's a loaded one.
This is going to take the rest of your day.
Yeah, I'll just hit you can ask questions as I go, but I think from so I guess to start with the approaches, just real generally without going into the dissertation, there's 3 approaches, right? The asset-based approach, kind of the floor, the minimum value, it's essentially what you would get if you liquidated, not quite, but it's value of the fixed assets minus any debt paid off, and then whatever's left over is the value. The market approach is the second one, the income approach is the third one. And the market approach is similar to the real estate market, buying or selling a home, you're looking at comps, right? And that's what we do with companies. We have private company transaction databases that we can go to, look at the deals that have been done recently that might be in a similar industry to get an idea for the multiples that those are selling for, and then see if they can be compared to your company. The last one is the income approach, and for most profitable operating businesses, that's probably the best indication of value because it's the essence of what an investor is looking at, right? What's in it for me? Why am I buying this thing? It's because of the future return, and that future return is measured in cash. What cash is left over, and then you just present value that future expected benefit.
Okay, we all play the tax game, so we don't want income,
Yeah.
right? At the end of the year, we don't have any income.
Perfect.
Thank you, Uncle Sam.
Yeah.
So I got nothing to show to a buyer. They say, I'm sorry, there's no money here. Of course, we've got new houses and cars and helicopters, but we don't have any money, so
Sure.
it doesn't serve us.
Right.
What about replacing income with the word cash flow, which is we thrive on cash flow, we're a cash flow business.
It is a semantics.
Right.
This is
Is
a
that
semantics thing,
semantics?
so
Well,
he'll explain.
And one of the big value adds of the valuation process is that we see through the tax returns and we recast the financials on an economic basis. So we present them on, from the perspective that a buyer would want to see them on, right? So we add back the personal auto expenses, we add back, maybe you own the building and you're depreciating it, right? All these things are significant adjustments to reflect what the true cash flow from the operations of the business are. Without getting you in trouble, we know that all these deductions are legitimate for tax purposes.
Ordinarily, so for our case, Bob and I, we have salary, we have dividends, we have expenses as part of the business. He's chairman, I'm just the CEO. I do all the work, he did his time. That value package, you put a number on it and put it back in, saying, when these guys go, all of that
Stays.
is yours, and that's really,
Minus.
Minus the value of some, assuming you guys play a critical role in operating the business, you have to assign a salary or some value to getting somebody to be in that
Similar
position.
actually, we're structuring the business to be standalone, because we recognize we're getting older. So we already have that there.
Yeah.
It's going to be in our payroll. So it should be, other than key long-term relationships. Like, that can be handled on a consulting basis or some kind of ongoing participation basis as long as we're breathing. I know Bob gets out of the morning up at 5 a.m. ready to go, so he'll be 110 wanting to give a hand. So we can structure that in to the deal, right? Yeah.
Yep, that's all looked at. And if you're taking a consulting salary and not involved so much in the day-to-day, then whatever compensation you're receiving would be an add back and would be, would go back into the cash flow that a prospective buyer could expect to distribute out to them.
Gotcha. Thank you.
All right, so what was the next?
Rules of thumb.
Rules of thumb. Okay, so it's funny because I was just valuing an insurance agency right now, and I was reading the rules of thumb, and it says there really are no rules of thumb. And a lot of them are big ranges, right? It's 1 to 3 times annual sales. It's 3 to 6 times EBITDA. So even looking at the rules of thumb, it's a range, right? Because they recognize that there might be averages of averages, which is basically what rules of thumb are. But it's going to come down to what are the specific characteristics of this business that we're looking at. The classic example is there's 2 businesses. They both have, say we're doing a multiple of annual sales. They both have 2 million of sales. And one of them is taking off, right? They're at this hyper growth phase like this. The other one is going down like that, they're tanking, but they just happen to intersect right there at that point in time to 2 million in sales. There's no way that a buyer is going to pay the same multiple for the company that's tanking just because they happen to be at the same annual revenue level. Right? And same would go with earnings, right? So you just have to look at the specific facts and circumstances of each company. Rules of thumb, that being said, they're a sanity check, right? They're a reasonableness check. Am I in the range of reasonableness? Is this in line with what's going on in the market? But we always look at the rules of thumb, but then we look at the private company transactions to see how those compare. The actual multiples are comparing to the rules of thumb. Sometimes they're close, sometimes they're not, and so it makes the whole process more informed by looking at it. So they are useful in that sense, but I would never suggest valuing your business based on rule of thumb.
How do you adjust your rates on doing all this work? Is there a percentage that you use, or do you just look at the work that has to be done? To write that, what they cost?
Oh, as far as the fees
Yeah,
to get evaluation done? Yeah, so we charge on the basis of an hourly rate. We've got a range, I've got staff at $100 an hour, I'm at $325 an hour. I'm more of a global guy, high level, so for a small operating company, it depends on, the complexity, right? If you have a lot of sub-entities that need to get independently valued, then it would be higher, but without those, I would say you're probably, just a broad range in the 5,000 to 10,000 for a full, kind of formal valuation. And then there's limited options that we can get fees down.
You have a question, right?
Yeah, real quick, so as far as the valuation, let's say I'm packaging my businesses, building 2 businesses, a year, stabilize them in year 1, whatever the case may be. And I said I want to sell out at my 5th location. However, that last location, I just opened it, everything else is showing, positive cash flow and everything. How do I value that business, that last business I just opened? Can I get the same multiple with the other 4 businesses or whatever the case may be, or is it average or whatever the case?
Okay, so the
And if
4,
they the same geographical locations.
okay, so same type of business,
Yes.
okay, and 4 of them have been around longer, 1 of them.
Yeah, yes.
Okay. So, are they all under one entity, or are they all separate?
They up under one holding company, but separate LLCs.
Separate, okay. So what would happen then is probably the newer one, if it doesn't have a 3 to 5 year track record yet, then we would have to do that one under what's called a discounted cash flow method for the income approach. Of course, we'd also look at the other approaches too, but the discounted cash flow would take forecasts, so whatever you expect that business to do, because there isn't a historical pattern yet, we've got to forecast out what the future is most likely to hold, and then we discount that back to present value. Whereas the other 4, if they're stable and they're just expecting kind of growth, in the 3 to 7% range, then you can look at the historical and say, yeah, that's a good indication of what the future holds. Do a what we call terminal amount, and then you just bring that back to present value. Charles?
The valuations that you arrive at, do you have a certification, kind of like you're buying a boat, you get a boat survey stamped by a guy, that has a value in the market. Does your valuation, is it recognized by banks, by lending institutions, by investment groups? I mean,
By the IRS?
Yeah.
yeah, the IRS.
Yeah, so the IRS has what's called qualified appraisals, and in order to produce a qualified appraisal, you've got to be a qualified appraiser.
Okay.
And I hold certifications that do meet those standards. We do valuations for SBA loans, so banks will come to us and we do valuations for those.
Great.
So, yeah.
Charles, when people start this process, what are some of the documents that they request from a tax standpoint? It sounds like that's important for valuation, that's important for buyers. What do you see, and if you have any advice on that?
Just I can share on the financial side, tax returns, general excise returns, your personal returns, and internal financial statements. They want to see that what you produce internally ends up being what you report to the IRS, right? Because you're generally going to be pretty on the ball when you file. So they just want to make sure that those things tie in. They want to see continuity and comparability between your internal financials and the tax returns. I think Scott can probably share on the legal side.
Yeah, we talked about some of the documents you'll need. I think from the tax standpoint, it's one of the closing things that a buyer will want is a tax clearance certificate, particularly if you're selling some inventory or things like that, where the tax department will say, yeah, they've paid all their GET or they're up to date. That doesn't protect against fraud, but I mean at least that they've paid their taxes and they're current. If you have a business with a certain level of employees or greater, there are reporting requirements, to Department of Labor and potentially, the U.S. Department of Labor is really big, and there's bulk sales transfer if you're selling, particularly all the business.
Stock certificate.
Yes. Yeah, stock certificates that you want to have. If you issue them, most people with LLCs don't do it, or if you don't have stock certificates and you did before, again, good reason to plan ahead as opposed to waiting till the last minute. Is we can reproduce certificates, or we can do certificates of shares based on loss certificates and do the proper things required under the statute to show that you actually own the company.
How do you address all the what ifs that Marco talked about? resignations, terminations, death, disability, lawsuits, bankruptcies, divorces, so.
So a lot of those things we can address if you're a corporation in a shareholders agreement, or if you're an LLC in an operating agreement, or if you're a partnership in the partnership agreement. Now again, sometimes companies will form and they don't think about these things until it happens and it's too late, and there's not a lot of guidance in the statute if there's a divorce and all of a sudden now you're partners with your partner's wife who knows nothing about the business and somehow owns 50%. So when we set up a company, we advise folks to think about these things. But if you've been running for a while and you didn't have a good operating, or you just have a boilerplate, you don't cover these things, we can cover them in a buy-sell agreement or in other specific provisions that deal with the what-ifs. What ifs if you die, or your partner who's critical to the business dies? We can create a situation where you can buy back the shares. We can have it financed through insurance policies or different tools like that won't create a problem for the business, that can keep going. Also, insurance is important for succession. If your partner is the president of the company and operates it, and you need him to be there and he dies, you're gonna have to hurry up and find somebody who's equally as good to replace them to run the business. And if you don't have the money to do that, like through an insurance policy, or if you have cash flow, great. But if you don't, you have an insurance policy, a key man insurance policy, that you can use those funds to hire somebody very quickly and know you can keep going. You cover divorce, cover disputes, major decisions come up and you can't agree on what to do. This one, all of us have been involved in or on the periphery of lawsuits involving this issue. So we can set up in advance rules of the game, whether it's, I like to just say, hey, at some point, one of you has to make the call. It's agree up front that who's gonna make that call. If it has to be 50-50, you have to have some kind of ability to break that, whether it's, kind of a buyout where one partner says, okay, we can't agree on this, I'm gonna buy you out, and the other guy says, well, what's your price? And the partner can say, well, this is the price, and then you can either match it or you sell. I mean, it's regardless of how maybe unpalatable it seems at the time, having a solution short of fighting for 3 or 5 years at millions of dollars in litigation is better than is a better way to go.
I can just add, so I'm one of 2 appraisers for 2 of these provisions that have been triggered, right? One's a family-owned business, one of them's not a family-owned business. But what happened was that they couldn't come to an agreement. The wording was poor in their buy-sell provision, and because of that, they're forced into this litigation environment where they've got to hire, the 2 parties hire their own appraisers, and then we meet, we exchange appraisals, and then if we can't come to an agreement, or if the values are way off and we can't come to an agreement, then a 3rd appraiser gets hired, and it's just, it is insane, the number of fees. And it's all because they just didn't update or even have this necessary buy-sell wording that specifies exactly what's going to happen in this event, how the ownership interest will be valued, and please have your attorney, the attorneys are great at drafting the documents, but from the valuation wording, it's critical because it can send this thing into nuclear zones of fees. So just be careful on the valuation wording. And ideally, you want to do it so that you don't have to get to that 3rd appraiser point.
So, speaking of fees, just all you guys are highly compensated professionals. Can you give some idea of what the fees are to go through the whole process?
So
Legal documents, you already talked about appraisal fees, financial planning, and of course the marketing of the business.
So Marco, can you maybe just, obviously you guys are all from different companies, but it sounds like it's really important that all of you work together. Can you describe the process of how would a business owner work with the exit planning advisory board, and then can each of you address the cost.
So inside of your little folder, there is like a steps how people get engaged with us. It says that the first step is, and I can walk you through that. It says the first step is initial interview where we meet with the business owners. You're kind of feeling them out, see what's going on. We are the first point of contact. We are your quarterback. We walk you through the whole process. We are the one who is designing the financial structure. We verify the financial structure of the deal with the CPA. We talk to Ethan before we get into that financial structure because we want to make sure that we have value so we know what we're transferring. But the first initial meeting is just to figure out what's going on. Where are you at? What are you trying to accomplish? How many years? Do you have identified buyers or not? So we sign the NDA with you. We explain the process. That first meeting is just like I said, introductory. Second meeting with us is going to be finding out a little bit more about business. What did you do in the business so far? Can we piggyback on something that you already have so we don't need to reinvent the wheel if you already have maybe some tools in a bucket? Third one is we figure out where you are standing personally, financially, and can you afford to lose this business? So if you're figuring out what's your personal financial soundness. Once we know all these details, we will know how long it's going to take, what we need to do, and how much hoops we need to go through. Then we give you engagement letter. Our engagement letter usually ranges from between $2,000 and $10,000. We did have one engagement letter just recently that was $14,000, but the reason why the price was higher because they were not located in Hawaii, so it would require 4 trips. They were located in California, so the engagement was higher. Right. Once we have the engagement signed with us, then we bring you in and we start the process. But we already know the information, so we already kind of know and we can expedite the whole process. The development of the exit plan lasts anywhere between 60 and 90 days. That's development of the plan. Once we develop the plan, and let's say you're transferring to internally to your people in the company, we need to pitch the deal to them. They need to buy into it. Once they buy into it, we figure out the terms of the deal before we go and see Scott. Scott fees is going to arrange, depends how many documents need to be drafted. But just for you just for your example, we had a client who needed to draft employment agreement, lease agreement, purchase of the stock agreement. There was 5 or 6 legal agreements that this client needed to do, and the client wanted to price it out. Scott came out at $15,000 for everything to be done because there was a multiple agreement. The competitive company in town, and I'm not going to mention the names, they came out at $40,000. Okay, so of course client came back and worked with Scott in that particular. So you see, we all have our own fees, so it's not going to be cheap. You're not going to get out of the business your PhD. When you go into college and sign up for PhD, it doesn't cost like $1. You pay $50,000, $60,000 to get your PhD. So if I want to compare it to that, this process is not cheap. You pay the CPA to do tax audits. They have their own fee. You pay the legal professional to do their documents. You have a business evaluator, and we already heard his range, and you have us to walk you through that whole process and structure the deal.
But to address the gentleman's question, we're looking for ballpark. We got a $5 million valuation on the business. Are we going to be spending $50,000 to $100,000 with you to
No,
get there?
that would be excessive.
That would be excessive.
That would be excessive.
That
On a
kinda
$5 million, you probably looking 1% potential total fee, and that will be on the higher end.
Well, 1% would be 50,000.
Right. So that would be on a
That
higher
would be
end.
on the high end.
Yeah.
Yeah, thank you, it kind of puts it, but what about the sale aspect, because you do marketing.
So if you're telling
find a
if
buyer.
you're selling to the third party, that's completely separate deal from the exit planning process, because we did the planning, we prepared the business, everything is done, now we need to sell it. That arrangement is completely different. You engage the M&A firm, they charge percentage of the sale, so that percentage of the sale can vary between 4 and 8%, depends on the value of the deal.
That's not you guys though? You don't?
No, none of us, yeah.
Oh, that's interesting, okay.
So that's like on the...
So an M&A firm is charging 4 to 8% of the purchase price?
Correct. And the firm that we're working with, they are charging on performance basis only, so they don't charge you any retainer fee or anything. There is a small marketing fee that ranges between $5,000 and $10,000, but that gets credited to that final fee once the business is sold. What's important that you need to know, usually in this situation when we engage third-party M&A firm to run the sale, they actually attract enough potential buyers, so you get, they lead you to the process what we call structural auction. So it's not that they're going to find you one buyer, they're going to find you a half dozen of buyers, and then they walk you to the structured auction. So you actually can get higher amount than what's the market value of the deal is.
Marco, has you experienced that if you engage the M&A firm, they generally will earn their
They will-
percentage back by
There
getting
is
to
a
a
difference
better
between
valuation.
business brokers and M&A firms. Business brokers generally put like 500 hours or something like that into the deal, when M&A firms puts like 1,000, 1,500 hours in a deal. So it's much more, even if they put like sometimes they don't even put that much. But the whole process is more comprehensive in order to attract the quality buyers. And their pool of potential buyers is unbelievable. From the private parties to the private equity groups, it's just like, there's no way someone will not pick you up. Unless you run into traffic.
Is there a minimum value of the company where you see
For
M&A
M&A, yeah,
firms
yeah.
involved? Because, can you
Yes.
address
And
that?
what would that value be?
So the value is like, business brokers usually get involved in the values less than $1 million. Okay? M&A firms, we see the EBITDA need to be 700, 800, but that's not a value, that's an EBITDA. That's your adjusted bottom line, what Ethan was saying, like your net profit plus all the add-ons. So your EBITDA need to be between 700 million, that's the range for them to find that, you to find the value working with them. Because then if the EBITDA is $1 million, then the value is probably 4, 5, 6, 7 plus $1 million. Right.
So you've got your pre-exiting package, these gentlemen, and then you've got your M&A. Are there any other pros in this?
No, because like we prepare you, and then depends if it's internal transfer, you don't need the M&A firm.
Gotcha.
You only need M&A firm if
For
you're
the
doing a
third
third-party sale. Okay, if you, and like I said, 7 out of 10 right now are internal, so you don't see the M&A firm because internal transfer. For internal transfer, this is it. You don't need anybody else.
And
Your,
bus-
no, go ahead.
Yeah, and I was just gonna say, business brokers will charge 10%, just so you know, that's my experience.
Wow.
And they might
Those are
charge
small,
you,
yeah.
and they might charge
Small.
you the fee to look for the buyer. So you will pay monthly plus the percentage of the sale.
Gotcha.
So it's like, depends on the buyer. Right?
I think one of the other advantages too, just from working with these gentlemen over the years, is the relationships that we have. You know, it's not necessarily gonna be the M&A. We might know people personally.
Yeah,
Like
that's
I know several people that are looking to buy businesses, and we're happy to make introductions. We don't charge a fee for that. At least I don't. And if it works out, then great.
Cool.
One more question. If you go external, I know from the market for businesses, either financial buyers and typically pay more, or strategic buyers
Right.
typically pay more. What's the environment today?
There's a lot of private equity money out there.
Yeah, and
And for
they
them
have to invest.
And they have to, and for them to buy business, they need to see the value. So that's why EBITDA is million. If your EBITDA is getting higher and you're 3 million, 5 million EBITDA, then you become more appealing to them, right? So strategic buyers are also something that you don't want to disregard, because strategic buyers is, hey, we have this same business in California and want to have a foot at the door in Hawaii. So we want to expand, right? Or other way around.
I think it's important to keep in mind too, when you're selling to a third party, at least in most of the deals I've seen, even larger deals, particularly deals that are sold to funds, you shouldn't plan on selling and the next day being able to walk out the door with your money and you
It's
go
not.
away. They're buying, but they typically want to buy all of it or a majority of it and keep you in there, and they're going to have some incentive base for you to stay in there, and they're going to make you sign a non-compete, and they're going to sometimes make you stay in the business, commit 3-4 years to make sure that there's a good transition. So again, planning is key, because we can start talking about these things now, so that when you're ready to sell in 3 or 5 whatever years, you've thought through these things and you're prepared for them as opposed to thinking, hey, I'm gonna retire in 5 years and I'll go see Marco, you know, in 3 or 4.
No, if you want to retire in 5 years, you see me now.
Yeah.
Right, in order for you to retire in 5 years. And by the way, what Scott said is absolutely right. When M&A, when a private equity is buying you, it's never 100%, here's the money and you out the door. It's never. Usually you get 40% of your cash up front. They wrap up the deal by paying off the liabilities or taking off your liability or your loans or whatever. Then they give you 3 or 4 year employment contracts with all the benefits and salaries and everything. And then they wrap you up into the new ownership equity of that new entity that they're going to set it up like 20–25%. So it's almost never 100% cash at closing. Another thing is they will leave probably 10%. What we see is 10% usually goes in escrow for a year or 18 months in case that something comes up like some skeletons out of the closet. So they're going to keep 10% of the selling price in the escrow for a whole year or 18 months until you go through the process, and then they will release the remainder of the money to you.
Marco, maybe talk about, I love the story when he talks about the seller's remorse, but how important it is for the seller to have a post sale plan.
So I like this, and this is a mutual client of ours who actually, we did the transfer like 4 years or something like that, 3.5 years ago, transferred to the younger partner, and he did have a seller remorse before he signed the documents. Now, every year we meet, right, so just to see where we at, because it's all earnouts and we need to update the financials. So he came like 2 weeks ago, and he said, Marco, we need to talk. And I'm bringing the partner that he transferred the business. And in front of the guy, he said, well, business is doing good, we're making a lot of money. I'm thinking maybe we should extend this deal, or maybe like pause on transfer of the shares for this year. And I cannot believe what he's saying. The guy is sitting over there like just like starts sweating. He's having a post-sale remorse. Like not prior to the sale, but post-sale. And I cannot believe it. And I said like, and I don't want to say his name, but I said, listen, you don't want to, whatever you do, if the business is doing well, there is a way how you can adjust your salaries and bonuses without touching the share transfer deal, because that's crucial. That will kill the deal if you start changing it now. Because the partner, the young guy, he's not dumb. He's like, no, he doesn't want to change the deal, right? So if you ever get to the post-sale remorse, do not bring the partner. Come to see me by yourself first, because like it's almost like a psychological sessions. Like they need to vent, and they need to bounce back the ideas, and then you kind of calm them down and show them how to do it without restructuring the deal after the sales are done.
That and it's important to have a hobby or have something that you enjoy doing,
right,
and plan for that as well, because you want to wake up the next day after the sale closed and well, what do I do? And you realize, hey, I love doing what I was doing, and that's what gave me fulfillment in life, and now I can't do it. So I think that's important.
I usually tell them find a hobby. So if you have a 5-year plan, you have 5 years to figure out the hobby, something that you're going to like more than you like your job, your business. Because if you don't have a hobby, most likely you're going to procrastinate to get out. And we have a few clients in the last 5–6 years that were actually undermining the deal. They didn't want to, like, subconsciously, they didn't want to let it go. So they didn't have a hobby.
Statistically, though, I think what you do is you sell your business and you die 3 weeks later. That's how they...
Well, that's kind of statistics will never get you out of business.
That's right.
I think that's it.
Any other questions? No, thank you very much to the panel. Thank you for coming.